Hi, John Taylor, investment banker, entrepreneur, and upcoming author of the book entitled Big Exit, The Business Owner's Guide to the Institutional Money Deal. So I did one video earlier where I talk about how business ownership is really the way to achieve significant wealth in the United States. And I talk about how, but only a very small percentage of business owners actually are able to achieve what I call the institutional money deal, primarily because the earnings of their businesses are just too small. And I'm going to talk about why that is and what institutional investors look for and who institutional investors are. So institutional investors, they're really the big money people on this planet. I mean, these people control literally trillions of dollars in investable capital, looking to invest in both privately held and publicly held businesses and other types of assets. So these are corporations, banks, investment banks, insurance companies, pension funds, hedge funds, endowments, mutual funds, just to name a few. I mean, so these people literally control trillions of dollars in capital. And what they're looking for, I mean, in most cases, if you're a private business owner and you want institutional money, there's kind of a minimum threshold you need to achieve even to be in the ballpark. So, in most cases, that's about $1 million, and that's really on the small end. I mean, that's just kind of entry level institutional money. I mean, institutional money, in a lot of cases, they're looking for the biggest deal possible. So they're looking for businesses with, 5, 10, $20 million in operating profits or more in a lot of cases. But, you can think about $1 million in operating profit is just kind of the, price of admission, so to speak, where you have to be to begin attracting institutional type of money. There are private equity firms that keep chasing kind of smaller and smaller opportunities out there, just because it has gotten more competitive. I mean, there's a lot of money that needs to go to work. These investors are looking for better returns than what they can get on like treasury bills, right? Which is a couple percent a year. Obviously banks are paying interest, so there's this. People are seeking higher and higher types of returns, and a lot of times they find that in privately owned businesses. So, we just want to talk a little bit more about what they look for in a privately owned business. So obviously, there's kind of a minimum level of operating profits or scale, as you can think about it. So if you're talking about a million in profits, 10 million sales, a lot of them is kind of the minimum size that a lot of these groups would look for. But institutional investors, I mean, they want to earn 30% in some cases or more on their equity investment. And I'm going to talk about how that works. You might say, whoa, that sounds really high. How's that even possible? It sounds like a ripoff to me. But, just to understand, I mean, those are leverage returns. So in most cases, what they'll do is they'll when they purchase a business, 50% of the purchase price is debt and 50% is equity. So if they buy a company for, say, 6 times earnings, that would imply a return on investment of about 17%, 16.6% on an annual basis, because 1/6 is 16%. It's just the inverse of 6 times purchase multiple. And so, but if they're buying with 50% debt, that's going to double their return. So instead of 16.6%, they're making 33.2%, or I'm sorry, 33.6%. So that's kind of how you might think about they would approach valuation, because they're using debt, and that's how they achieve some of these returns. But they use other risk mitigation techniques to make sure that these investments work out. So obviously they're looking for companies that have a strong management team in place. These guys are not looking to operate the business. They want companies that already have a good management team, and they'll incentivize that management team to grow the business over time. Limited customer concentration. So really, if a company has more than, say, 20% of its sales to a single customer, that could be viewed as a risk, because if that customer went away, how does that gap get filled? I mean, that could really put a big hole in a company's profitability. So really, if they're looking at that top 10, they're hoping that probably no more than 50% of their sales are to the top 10. So obviously, the more diversified a company is in its customer base, the better. High profit margin. So 10% or more profit margin is sort of a rough rule of thumb. So operating profit, I mean, obviously, if a company's operating at 10% or more profitability, you can afford to maybe make some mistakes here or there and still be profitable. Whereas if you're operating at a 1 or 2% profit margin, it doesn't take many mistakes to to lose money, right? I mean, you'll be running in the red fairly quickly if it's a low profit industry. So think about like the grocery store business, right? I mean, it's something that operates on low profits. Significant competitive differentiation. So does the company have intellectual property, patented products? Are they the high quality provider or a price leader? Do they have some significant scale that kind of helps them compete in the marketplace? I mean, really, it's just the idea that you need to be different. If you kind of, if you think about the blue ocean strategy, I mean, you want to avoid kind of fighting it out in a highly competitive market and fighting over price. Whereas, if you have ways you can differentiate yourselves to customers, that's powerful. You can achieve higher profits and you have greater stability over time. And also, they want to invest in companies that have growth opportunities. So they're not looking for the buggy whip industry, right? I mean, they want companies that have significant growth potential, and they're not. It doesn't have to be annual, 100% annual type of growth, right? It doesn't have to be some high flying tech company like Facebook that's growing 200% a year. These could be business services. I mean, fairly mundane businesses that generate good profits, that most people wouldn't be aware of. Metal bending, metal finishing type businesses that just year in and year out make good cash flow, good profitability. Maybe they're only growing 3, 4, 5, 6, 7% a year, but with a good strategy that could be optimized, and the company could increase its profitability significantly over time. So anyway, I mean that's just sort of an introduction to that second chapter, and hope that gives you kind of greater insight into what an institutional money deal is and who institutional investors are, and how those guys think and work. So if you'd like an advanced copy of my book before it comes out, you can email me, John. That's JON @StantonParkLLC.com. Thank you very much.